Thank you everybody for joining. My name is Shane. I run the events over at 10 Capital Network, and we have a great event for you today about blockchain and the 8 golden rules for blockchain investors. If you have any questions during the session, go ahead and drop them in our chat box and we'll get to them when we can. We should have plenty of time today for questions. So with that, I'm going to pass it off to Hall to get our special guest introduced.
Great. Thanks, Shane. And I want to thank everybody for joining us today. We have a great treat here with one of our favorite investors, Chris Kameir of Sustany Capital out of Newport Beach, California. He's a longtime investor in the crypto world, in particular Web3 and blockchain. And we invited him to come on and talk about what's going on in the blockchain world. There's many things happening today, and felt like it was time to have someone give us a level set from an investor's point of view. What should you know about blockchain in order to make an investment? And Chris is here to give us the benefit of his experience. And if you have any questions for him, go and post them in the chat box. We'll have some time during and after the presentation today to answer those questions directly from Chris. And if you want to be connected with him directly, we can do that as well. And then after that, we have a startup pitch from James Jackson Leach of DeFi Films. And Chris and you can give your feedback and comments about what you think about this deal and any questions you have about it. They're raising funding. So with that, let me go and pass it over to Chris. Chris, thank you for joining us. And let's go and kick off with your presentation about the blockchain.
Yeah, thank you for the kind words. Yeah, I started programming in 1984 on a used Commodore 64. Back then, that wasn't actually cool. You were a nerd, but not of the cool kind. My computer had a tape deck for data storage. I later interned at Siemens, learned to code database solutions, but then enrolled in a university program to get a degree in linguistics and classical literature, but went on to law school. And while I was working on my doctoral thesis, I joined a startup as in-house counsel. And we started to build a unified messaging system on the AOL backbone, which was ahead of its time during those days in '95. Today is still ahead of its time. It's one of those lessons learned that we're going to talk about. But I went on to become chief legal officer of the first private internet service provider in Germany. And at the height of Web 1, we sold that company for, at the time, €250 million to what's now the largest ISP in Europe. So at the time, I immediately retired from the law and a few months later permanently relocated to Southern California to warm up. And I joined the family office in San Diego and did this for a couple of years before I had the urge of running my own startup for some time, which I sold in 2009. And at the time moved into angel investing in the Web3 and blockchain space. And that's how I met my partner. He created the Ethereum meetups here in Orange County. He's a doctor and scientist by training in microbiology, but he's a very successful angel and Bitcoin investor since 2012. So we hit it off right away. We have the same philosophy, mindset, and approach to technology and technology investing, which means we're trying to apply the scientific methods as much as possible to the topic of investment. So hence those 8 rules that we're going to talk about.
That was very good, very good. But thanks for telling us about yourself and your investment firm. Let's talk about the fundamentals of blockchain. And I think some people in the audience are very familiar with it and some are not. So we may need to do some explanation with it. So let's talk about, first question is, how do you decide what investment space to focus on? What is the first rule investors should follow?
Yeah, so as an investor, and that's generally true, you must first determine what is your circle of competence, and then you need to keep improving in that circle. So from the vantage point, you then make the most important decision, which is really what not to focus on. As a venture fund, we receive a large number of funding requests daily. So to save our attention for projects that are within our circle of competence, we must be able to efficiently screen these proposals. And to that end, we approach the investment process like a scientist would advance the expansion of his own field of study. So by building a thesis and consistently improving upon. And this means that we approach all discussions with startups with kind of a peer review mindset, where we get to present and compare our thesis on a particular business problem with that of a founder, since the startup is essentially running an experiment on that thesis. So now we have done this more than 2,000 times over the past 6 years. that obviously has evolved our thinking, allows us to focus on the most promising developments. And one could say we now have the equivalent of multiple doctoral theses on topics like the future of lending technologies, evolution of currencies, digital property rights solutions. And indeed, we're planning on publishing these findings in a book format in the near future. And we're very involved with an Ivy League school where we already teach that topic. And as a result of our research, we made one investment for every 200 projects we evaluated. So 2 of these investments are unicorns, and we exited 2 positions, which already returned most of the fund, putting its performance near the top of venture firms across all segments. But more important to us is that it proved the thesis that we built.
Great. So we had a question from the audience that I think is on a lot of people's minds. The question is, what is wrong with Charlie Munger's view of crypto that it is just gambling? How do you respond to that?
I mean, that's exactly what I just talked about. It's outside of the circle of competence. Right? So it's outside of the circle of most people, because these technologies, and we're going to talk about that a lot, exist at the intersection of a new technological paradigm, as well as legal concepts, as well as incentive systems, as well as other paradigms. So he speaks about something that he really fundamentally doesn't understand. I'd love to have 5 minutes with him, because I don't actually think it's too hard to understand once you understand the fundamentals and you can see the value of these applications. Obviously, we're going to talk about that a lot. Really, if you listen to that, I'm convinced I could change his mind.
Okay, well, great. And so you mentioned technology adoption. How do you think about that as a third rule for investment decisions?
Yeah, so we take very much a first principles approach and favor technologies that show signs of being essential to network systems and ultimately always real world economic activity. So a counterindication here is any solution where you have high customer acquisition costs, which is a standard due diligence question for every investor. So a company that has to spend a large percentage of their raise on convincing customers to use their product is likely less viable than solutions that find users organically, specifically in the technology space. So this is even more important in the current environment, obviously, of general economic downturn, where companies and individuals limit spending to essentials. So our strategy is to identify what we call forcing functions, which make the adoption of technologies non-optional. So let me give you a few examples to make this more tangible. So the 4 areas that we kind of honed in on, and that seems probably counterintuitive, is A, cybersecurity, B, government mandates, C, central bank digital currencies, and then D, digital driver's licenses. And as you know, I speak about all of these topics for a long time, so I'll just explain the last one real quick, and we can go back to that if that's more interesting to people. So anybody who has an iPhone can pull up the digitally native wallet right now that Apple provides, and you will see that 3 states adopted the paradigm of digitally native driver's licenses. So these are cryptographic primitives that you store in your enclave. And so this is a forcing function, because at that point in time, where you have government issued credentials that you need to facilitate certain transactions of daily life, checking in a hotel, renting a car, or facilitating commercial transaction, then it becomes non-optional to be able to integrate these. As in, you need to understand those. And these are cryptographic primitives. And then to the topic of cybersecurity really quick. So it seems to me it's very much a very narrow and to some extent false view to abbreviate crypto in terms of referring just to cryptocurrencies. It's really about cryptography. What's cryptography about? It's about security. It's about securing data transfer and data control. And what is less known by the public at large is that cybercrime is a tremendous industry, exceeding about $6 trillion last year. So it's larger than all but 2 GDPs of countries out there. So point there being is at the core of that are legacy technologies. And to simplify this, let's call this database solutions, which you cannot protect. And you mostly cannot protect those because you have a permissions layer that's being controlled by a number of people who then have wholesale access to all the data that's sitting in these databases. Anyway, I'm going to curtail it there because I give a 3-hour speech on that topic specific.
Well, back to the investment decisions, I assume one of your investment rules has to do with the size of the opportunity. Is that right?
Yes, so the size of an investment opportunity is often directly correlated with the size of the market. A standard question we ask every startup and probably most investors is that of what's the total addressable market, as that will to some extent determine and limit the return on an investment. So we ask ourselves the same question within the universe of all investments. So as first principles investor, our starting point is literally global gross domestic product. So at the time was 96 trillion. And then we dissect this further in the largest categories we view within, again, our area of competency. So if you want to pick out some big examples, the largest area would be finance. So finance, the opportunity there, we value at about 16 trillion. So again, that's in the backdrop of about 96 trillion global GDP at the time when we established these numbers. And then we break it further down in that particular case in 14 different segments: programmable money solutions, insurance solutions, trade financing, lending specifically. So we made investments along those lines. And then the second large category, and as you know, I've somewhat grime with that term Web3, but let's use that term for the time being, is Web3 solutions, which we think is somewhere in the opportunity, somewhere in the neighborhood of 13 trillion. And here we have the same number of segments that we are looking at. And to just mention the largest one, what we need to build, what I call the internet for the first time, is decentralized bandwidth, decentralized storage, decentralized compute, content authentication, voting systems that are decentralized. So in all of these segments, and that's important to us, have the potential for several unicorns, which is rather unusual.
So the way you explained it, these first four rules can largely be explained, be applied to investing in general. What are the four rules that apply to blockchain investing in particular?
Yeah, so the first thing that always comes to mind with people is teams. So, and there specifically for the blockchain space, as an investor, you must understand if the operators of a project have a clear understanding of the fundamental functions of the technology and its application for particular use cases. I'm going to break this down. So that means first that the investor must be able to formulate the right questions. The quality of your answers is directly correlated to the quality of questions you can formulate. And so consistent feedback that we are getting when we're talking to startups, probably once a week, is that the type of questions that we are asking have never been asked by any other investor before. So that's good feedback for us that we're kind of on the right development track here. So then one of the first questions we pose to a startup founder is simply to explain the functions of a blockchain. And today, very few entrepreneurs can provide a functional definition for blockchain. So as a result, then downstream, we can observe implementation errors. And I'll give a few examples to make this more tangible. So in blockchain-based solutions and as differentiated from databases, and again, blockchains are not databases. You shouldn't store anything on a blockchain. And to make this clear is, imagine an example where you create a quote-unquote immutable record out of personal identifiable data, your name and address and so forth. Well, now you're no longer able to comply with certain rules and laws and regulations, i.e. GDPR, the right to be forgotten, same under California rules. So your application has just been invalidated. You can start over, right? So the point there being is, and I always simplify this to make this obvious for people, that a lot of times people don't differentiate between functions of the technology and its particular use cases. And the simple way of looking at this, the function of a technology like a hammer is always exactly the same. It centralizes centrifugal force. And then your usual use case would be to put a nail in the wall. So if you deploy it for another use case, i.e. harming another person, it didn't touch that function in any way, but obviously it's an illegal use case. And we can break this down further, but I think we're gonna move on to what I call rule 6. So we, as an investor, we must be able to understand the values being accrued. So traditional capital formation was concentrated through corporate structures in which investors could buy equity. However, the Bitcoin design paper introduced an entirely new paradigm we refer to as decentralized autonomous organizations. So as such, there is no Delaware Bitcoin corporations investors could buy shares in. However, the Bitcoin network observably provides utility to its users, and they are paying for that utility in a currency that's native to the network. Confusingly, that's also named Bitcoin. And so when we write about that blockchain, we use the uppercase B for the network, and we use the lowercase b for the mining reward to differentiate that. So the combined value of these coins today stands about at 472 billion. And Bitcoins are very liquid with many markets around the globe. But then to identify the actual values being accrued, we first need to take a step back and recognize that this network exists in a larger context of network infrastructure. And there's 5 basic building blocks that make up network infrastructure, which is access, so that would be an internet service provider, bandwidth, compute, storage, and then security. In the legacy systems, these are functions that are centralized in companies such as AWS, Google, Microsoft, etc. And they store and secure your data and allow you then access through something like a username and password, which enables you to manipulate a small portion of the data that's stored. But then they're charging you in some shape or form for maintaining these ledgers, right? So legacy financial institutions work in much the same way. They maintain a database which stores information about what you're owed and what your obligations are, and they provide you with a username and password, which allows you to some limited access to these ledger entries. And in return, they charge you and entities interacting with you with fees for changing the entries and keeping them secure. So in blockchain-based systems, it's more granular. The entry is granted to a single key holder. There's no middleman who also has access usually. And the security functions outsourced to an independent network of security providers called, in this case, node operators. And all of this applies to other blockchains, but Bitcoin is sort of the simplest and mother of all. So the fees for the service is paid partially by new issuance of Bitcoin as a network function and partially by fees assessed to users of the network. So as such, the network accrues value, which is captured in its native currency and expands with greater utility of the network. So the primary, and that's important, the primary use case of Bitcoin is to secure the network. And then the secondary function is to pay for fees to make use of the network. However, and again, this is where it becomes important to distinguish the level of use cases. What we can observe as of today and measure are 2 secondary use cases, and which usually dominate every conversation, which is A, speculation on the mining reward, and then using Bitcoin as a long-term store of value, which is about equal amounts. So these secondary use cases currently affect 95% of the Bitcoin market cap. But both are equally effective by the expansion of the network by things like second layer solutions, such as Lightning built on Bitcoin. And then from there, you can see value accrue into the application layer. So as in, if I want to run a company, I can use the Bitcoin network as a settlement layer. And once in a while, I will reconcile to the settlement layer as a security function, but my application is running on top of that, and I might utilize that application to create another revenue stream. And most people might know that Square actually outsourced an entire division that just does Lightning development. And obviously the value in this particular case will accrue then to Square and the shareholders in that company, now called Block actually. So then rule 7 is you really must be able to identify the use cases. So what are the actual use cases? And here to take a step back and explain what is the function of a blockchain. There's a singular function of every single blockchain, which is very simple to change control over a set of bytes from one address to another, from one controller to another. So that's very different from the legacy system of database solutions where you got write, edit, delete. So it solves for the database solution. And it's very important to understand that blockchains don't record anything. Blockchains are state machines. They hold a certain state and they move it on. Think about, if you need a metaphor, your most simple vending machine, like a good old-fashioned gumball machine, where you put in a coin, you twist the dial and you see the gumball come out. So it's more like that. So whenever people will tell you that the use case is to report something, they're just simply wrong. They're using it wrong, right? So it's not the use case of a blockchain-based solution. And chances are, and then we get into the due diligence framework that we're building, chances are you what we call invalidate the herd immunity of your blockchain, of your application. Because again, you might creating an immutable record or otherwise create an attack vector. So then we get to rule 8, and then we'll go back to you asking questions, because I tend to trend towards monologues, because these are concepts we've been teaching for a long time. So you must be able to create a due diligence kit which identifies these single points of failure. So blockchain-based solutions exist at the intersection of new technological paradigms, so incentive systems, legal systems. And there, what we see consistently is that you have engineers that are trying to implement what are essentially legal engineering solutions, but they don't have an understanding of legal concepts. So they don't understand what's the difference between authentication, verification, certification, identification. And they tend to build metaphors and then implementing these into code. Well, that cannot work, right? I cannot come up with a metaphor and then implement this into my software. You cannot facilitate real-world economic activity with that, which is something that we are most interested in ultimately. I mean, it's interesting to maybe speculate on some digital collectibles, but ultimately the economy is about selling products and services and facilitating that activity, and everything else is kind of ancillary. Specifically, as far as I'm concerned, all financial services are just conduits to exactly that. Anyway, I'm going to stop here because I have the tendency to run into monologues.
No, thank you for that. And so how should investors view Web3 and blockchain solutions as a part of their investment portfolio? What role does it take?
Yeah, so if you take a step back and talk overall about portfolio distribution, and you probably should think in your typical terms right now of keeping 20% in real estate, 25% in publicly traded stocks, probably 5% in cash, at least at the moment. But then 50% should be in private equities, so what we are part of, we see. So asset classes such as real estate and stocks have seen a very prolonged distortion, which is rooted in very unsound fiscal policy and monetary policy, which have artificially inflated these asset classes for some time now. So it seems plausible that real estate and public stocks will mean revert to their historical balance in reference to overall GDP. And so additionally, what we have seen is that there has been a strong trend over the past decade to capture most of the value of companies in the private markets in the public stages, in particular due to the proliferation of late stage funds. So within private markets, then if you break it down further, technology will continue and to outperform other sectors, we think. And Web3, now we're getting to the core of your question, blockchain space at the center of that, because it addresses most technology debt that was accrued by companies that today mitigate commercial activity at scale. So financial services, for example, had revenues exceeding $22 trillion. And again, to recall that in the context of a $96 trillion GDP. So the way I look at this is just damage to the real economy. So finance is a conduit to the exchange of real products and services, or what I call the real economy. And the IMF calls the real economy. And then cybersecurity, as I mentioned, is another $6 trillion. So now we're looking at an investable space just in terms of efficiencies. So I call this kind of the marketing budget that nears 30 trillion, so that nears almost a third of global GDP. And I'm not even covering more granular things like supply chain integrity, et cetera, et cetera. So big picture here is really think about all of your daily activities that involve some form of database solution. Our thesis is that over time, all of these will be phased out by, let's call it Web3 solutions. I have some nerdier terms for that, such as mapped cryptographic primitives, but really solutions that provide more data integrity and more data control. And again, to us, the way we look at this, these are non-optional adoption. So that provides us with a lot of security in our investment decisions, to where we're not investing in the next micro mobility startup, right? That's not something we will be interested in, because the landscape of opportunities for changing real world economic activity at scale is so large right now. That will never happen again. And I typically, so when I teach my class at Harvard, I walk people through like the steps in human history that we went through. We really started only a few thousand years ago to record transactions. So all of finance, all of commercial activity has always been ledger-based. We kind of started out with the wetware in our heads, where we started to remember what we were owed and what someone else owed us. And then we discovered writing. The earliest forms of writings are called cuneiforms. They were just clay tables. And then some 3,000 years later, we replaced those with paper-based solutions. And then only in the 60s, we replaced these with database solutions. So what we're doing now is essentially liberating these bytes from the databases that they're basically being held hostage in. Because every time you have a database operator, we touched on it earlier, you obviously have someone who's being extractive and who also can then censor certain transactions. And then in the worst case is really that we observe, if you think of companies that maintain databases that have your personal identifiable data in there, of which there's 4,000 to 6,000, and they have as many records, meaning they have 4,000 or 5,000 records on you. And how are they using these records? And what I call, how are they using your digital dust? Well, they're using them to manipulate you. They use them to sell what I call social engineering as a service. So a lot of people will call that advertising. But if you think about this a little more, it's really not advertising, right? What they're offering their constituents is to change your behavior. That's the objective of these platforms and how they use the data that you're collecting. So ultimately, I really want to see a reversal of that paradigm, or what I call, you get to own all your digital dust. And essentially, that's the concept that Bitcoin introduced. You can now own, control all of your digital dust. Bitcoin is just one example of that, but you should translate this to anything that's digital, where you don't need a middleman. It's more efficient, it's more secure, and as far as I'm concerned, it's more ethical and more in alignment what we consider in the United States as our constitutional rights. Anyway, that's a topic I'm very passionate about. That's how I usually end up on this, and I speak a lot, have been speaking about this for 15 years at this point in time. And it's just so happens that in the meantime, while we're pursuing this objective, we just stumbled across the largest investment opportunity in human history, because we're changing global economic activity for the first time using a new technological paradigm.
Great. So, well, is now a good time to invest in the Web3 space? Why or why not?
So if you look at the adoption curve of these technologies, then if you're very charitable, you have about 2% adoption. So that's the equivalent of the time when I was selling dial-up services in '98. We were very, very excited about the 56K modem coming about, which meant that a page on Amazon would load in about a minute. And we had 1,500 affiliates running around. They would install dial-up modems into people's computers. And that's kind of where we are today in terms of these technologies. What do you have to do? You have to install a runner, or people usually call it a wallet, like MetaMask. And that's what lets you manipulate entries on a blockchain and participate in certain network activities. So it's rather cumbersome. So if you think about that, the investment opportunities that you had in '98 were enormous. was the first real paradigm shift in terms of information distribution, asynchronous and synchronous collaboration opportunities. That's at the end of the day what makes economic activity work. So now it's a much larger step, but we're still in the adoption curve as early as we're in 98. So now's absolutely the best time to get into that space, because now you can pick companies that simply by them being early adopter, early distributors of these technologies are destined to be unicorns. That's the greatest seed you could ever imagine. If you understand, again, this technology paradigm, which most people just don't spend the time on learning, unfortunately.
So where do you find good startups in the Web3 world? What do you think is a good source?
Yeah, so we are very much part of the ecosystem, always have been. We're operating the Ethereum meetups here in Orange County, but I've been writing about these concepts really for 15 years. For us, I use this term, which is not so sexy, called decentralized software solutions. So but if you look back to the days of file sharing, this is really the principles that emerged back then. And I was a big user of Kazaa and Napster and other systems. I think most people on this call were at some point in time. So they introduced some of these paradigms. So we are part of the open source communities that build these solutions. We have our own Skunkworks development division. We have our own non-custodial wallet that we built that's in the App Store. We write a lot of thesis papers that we share for peer review. So most of the things that we see at a stage where the team hasn't built a deck yet. And that's the right time to engage with them. As an investor, we don't invest in dots, we invest in lines. So we get to monitor these solutions long before they ever even start to create a deck, and usually help in that process. And that's somewhat of a feature of most of the innovation being built by the open source community. If you think about this, the World Wide Web is not run by Microsoft, it's not run by Google. It's run by technologies that were introduced by volunteers that used what's the main driver for the evolution of knowledge. It's called cognitive surplus. So it's what I'm doing right now, sharing certain knowledge, implementing it in the world. And that's how we drive human knowledge forward. And so you have to be part of this community. You have to speak the language of that community. And it's fairly easy to spot what we call tourists in the space. So if you hear someone saying words like DLT or use the word blockchain technology versus blockchain-based solution, he or she identifies him or herself as a tourist. Because, like, to give you that example of blockchain technology, the Bitcoin white paper didn't introduce blockchain technologies, actually indirectly referencing it in the second footnote, which is a concept that was introduced 10 years before the Bitcoin white paper. It's essentially an enhanced version of cryptography and encryption. And it's a little bit like confusing, like using internet technology with the internet. So if I use some internet protocol like SMTP, voice over IP, to build an application, that obviously doesn't mean that I'm building the internet. So it's the same with blockchain technology. You can use blockchain technology to provide you with a secure application. That doesn't mean that I'm using a blockchain. And same with DLTs. Distributed ledger technology have nothing to do with blockchain-based solutions. They're more of the same. They're shared databases. And unfortunately, there's a tremendous amount of misinformation. A lot of that is by like incumbents, by legacy technology providers that like to slap that label on there and confuse people. But ultimately, it comes back to the World Wide Web is not run by these companies, and these new technologies are not being developed by these companies. At the end of the day, what will make these networks faster and better is a principle we take from evolution called the law of requisite variety, which means the most flexible within a given system will rule the system. And so that is the earliest adaptation. So these solutions consistently change. That's why it's almost always a fallacy to take a certain time in a certain point in time and talk about the technology that is open source, because the technology might entirely change, just like certain use cases obviously changed. If you look at Ether as one example, the reward mechanism on Ethereum, was created for a particular purpose as a DDoS protection mechanism, as a security mechanism. And then people found out the use cases for it. It evolved, and the network evolved, and it keeps evolving, right? So that's why I think you're going to ask me about regulatory uncertainty. That's something.
We'll get there. So we had a few questions come in, and just to go to the audience questions here. In a country with insecure property rights, one can see that the intellectual model of crypto can protect one's assets from seizure. However, in a legal framework, transaction costs of cryptocurrencies mean that they are simply uncompetitive with existing money markets. So why use them? What about this, disparity between current investing instruments and the upcoming crypto ones?
Well, obviously that statement in generality is just false, right? So you can, there is no network, and we can go through the different networks, but there is no network in the world outside of blockchain-based solutions where it can move $1 million in the next 10 minutes. Doesn't exist, right? So it cannot compete. It being the legacy financial system cannot compete with that. There is no final settlement in legacy financial systems because they're ledger-based. So that they are just agreements, and they can be reversed at any given point in time. And most people have had that experience, that things just don't settle in any given amount of time. And even if you're just trying to move $10,001, you have a lot of friction, right? But then, so in terms of costs, again, you want to pick the right tool for your particular function. You could probably run the entire Visa network on Stellar. I think at one point in time, we figured out at about $24 of cost a day, the entire Visa network, with the added benefit of this will be a settlement network rather than a messaging system, which is an important distinction. All the legacy networks are messaging systems. They can call them payment systems, but that's just legally false. They're just sending a message. And the recipient of that message can then decide, and usually will, okay, I want to act on this message. So you're sending a message to your bank, and JP Morgan or Bank of America, they make their own decision based on their own terms and conditions. I want to act on this, or I don't want to act on that, right? Ultimately, that's not the case here. But in terms of cost, again, use the right tool. Right, so you can, I just did a couple of Polygon transactions. They were I forgot, 3 cents, executed instantly, did some listings on OpenSea just to play with the technology. So it was insignificant and instantaneous, more importantly. Just if you contrast this with me having to put like a credit card into an interface, just the time that it would take to put that information into that interface will take longer. And what's neglected here is obviously right now, whatever you're buying is inflated. It's inflated by at least 5%, because the merchant who you're buying something from that's accepting this credit card, he pays a merchant account fee. And so he also then adds a buffer to account for things like chargebacks, and that will simply inflate the product and service that you're buying. Whereas technically, if you do the same transaction with cash, well, at that point in time, you didn't have that transaction cost yet because this other parallel system exists. It's still inflated. So the contrast here, again, that's a very important concept to understand, is these networks are entirely different from the legacy messaging systems. They're actual payment systems, they're actual settlement systems. You're using a digital bearer instrument to facilitate your transaction. And coming back to costs, you got a dozen different networks that facilitate transactions at costs that are far below what any legacy service provider would charge you. And oftentimes these transactions would be just entirely impossible.
Great. So my next question is, how much of a position did you have in FTX, and what do you think of FTX situation?
None. We had absolutely none. So when we see something coming across our desk, we have a standard list of questions that we need to have answered. And if there's no answer to these questions, then our answer to your investment request is no. It's very simple. We're 100% data driven. We haven't been affected by that. And we have an investment in a custodial exchange that is safe and sound, and that provided us with all the data we asked for right away, had a complete data room. So if you're an actual investor, so what I mean by that, if you have a very sound investment framework, then you should have never ever given a company any funding that couldn't provide you or wouldn't provide you with these data points, which again, anecdotally, that hasn't happened in this particular case.
Next question is, what is the use case for Bitcoin? It is useless as a currency and a highly risky asset, so hopeless as a store of value. Gas fees are 20% or more. What's your take on Bitcoin and where does it fit?
Okay, so there's 3, 4, 5 different conflations in here. I talked about this earlier, but I'll go through it again. So Bitcoin mainnet is the settlement layer. If you want to use Bitcoin for transactions, you should use the Lightning Network, and then you have very little transaction fees. It is true that the use case today is A, as a speculative asset, and B, as a long-term store of value. And the value ultimately will increase as the use cases built atop of the Bitcoin network are increasing. It's true for any solution. That's why I remember very distinctly in '98 that all my friends that were not so close with technology said, yeah, so this internet thing will never catch on because it's just so difficult. Everything takes so long. I need to dial in and it's expensive. Things were metered by the minute. These are early days, but then overall we see the use cases increasing. And to me, it's gross negligent if you don't have at least a percentage of your net worth in Bitcoin, the mining reward at this point in time. And again, it's important to differentiate between speculation and investment. Investment, demarcation line for me personally, everybody can draw their own, starts with thinking about anything that you're buying, assuming you want to hold this for 5 years. And I would take anybody's bet on a 5-year horizon to hold any other asset compared to Bitcoin. And you're pretty much on the safe side that Bitcoin will outperform that other asset over that particular point in time. But again, it should be part of your portfolio. It shouldn't be a large part of your portfolio, but not having any of your assets in Bitcoin as kind of schmuck insurance is just simply gross negligent in my personal opinion, right? Again, not financial advice. That's just how I feel about that. Part of this is the obvious thing that always comes up, which is the Lindy effect, as in this thing has been around for more than a decade. It's been attacked by regulators. It's been attacked by hackers. It has withstood all of these. And we have no indication that this will go backwards at this point in time. It's just very, very unlikely given the distribution of the technology, given the distribution of nodes, given the distribution of people that have been holding on to it in some cases, in not insignificant cases, for more than 5 years specifically. There's a really interesting chart that shows how long people have been holding their Bitcoin positions over certain years. It's kind of this layered cake visualization, which is very interesting. But to me, most interesting is really building use cases on top of that. So when you see that a company that's literally still called TBD, that was spun out by Block, that entirely has devoted itself to Lightning development, then you see an indication there by one of the largest payment services providers in the world that's betting on it, that this is going to be a thing. Outside of the fact that we have a very, very long list of very reputable companies that have invested in this particular asset. Again, always setting aside Bitcoin lowercase b being the asset, and then Bitcoin uppercase b being the network, whose utility is increasing.
Right. One more question is more of a statement. Most recent developments in blockchain are evolving to allow you to move any value and settle in seconds at nominal costs. Once the technology is mature, it's simply faster, better, and will be radically cheaper. What's your take on the evolution of the technology? How fast is it getting to this better place?
Yeah, so it's very different across the world. So you can kind of bifurcate that. So what I always say is usually in the developed nations, it's not a technology problem in terms of its adoption, it's an incumbent problem. Obviously, we have a lot of incumbents in the developed nations that don't want to see the adoption of these technologies. So if you're a good parallel to this that I always bring up since I've been in that space for a very long time is voice over IP, the technology that we're using right now. When voice over IP was introduced, there were telecommunication companies that were lobbying their governments really, really hard to outlaw this. And to this day, some countries outlaw the usage of these technologies. But then again, did people download Skype to make free phone calls to their relatives in other countries? Of course, because if the alternative was not to talk to those relatives and or be nickeled and dimed by the local telecommunication companies, which they couldn't afford, they would still quote unquote violate the law, download this technology and use it, right? And so larger point there is where there is no technology, i.e. where I don't have a bank, where I can't even get a bank account, and that's more than 1 billion people in the world because I don't have government issued credentials. And I have the option to download a digital wallet and start doing peer-to-peer transactions. Well, that's literally the only game in town. So these individuals will just simply leapfrog the banking system, and for them to then go back in time and use something else like this legacy banking system will seem about as sensible as going back to a phone that's tethered to a wall with a cable rather than using a smartphone. That will be just seem implausible. So then the other adoption curve, and we have investment in that space as well, is just companies that are building solutions that integrate with these legacy technology providers, right? And so where they then kind of offboarding and start to implement these efficiencies. So settlements on top of certain networks, think stable coins within a certain context where before that you needed to use a fiat currency. Because again, comes back to fiat currencies, so ledger-based solutions, the legacy system cannot settle instantaneously. So you're always creating, for no technical reason, a counterpart, which its own credit risk with its own terms and conditions, right? So it's simply from a technology perspective, way more efficient. So we can already see these in the developed nations. And then last point there, because it's a point I can talk to a very long time, is some countries actually now demand that all their government functions must be blockchain based for transparency reasons, right? So in the UAE, they have devoted themselves to have all blockchain, all government functions on a blockchain by next year. Same holds true for Dubai. So their thinking is just less informed by K Street, is less informed by the incumbents, right? So all of these problems we are talking about, they have been technically long solved. So it's bifurcated whether or not the adoption is being hindered by incumbents, or it's being it's a lack of existing infrastructure that these technologies could evolve on.
Great. Our last question, and then we'll hear from a real-world Web3 company, is what is the most complete DAO ecosystem that you are aware of?
The DAO ecosystem?
Distributed Autonomous Organization ecosystem.
Yes, sure.
Which one do you think is the most complete at this point?
Yeah, I should preface that with it's my most favorite topic. Is actually the first article I ever wrote for Orbs was on specifically that concept. I think it's the most important concept introduced by the Bitcoin white paper, actually more important than anything else. It's this different type of capital formation. Unfortunately, I keep diving in and out of the system to see who's providing a useful framework. As of now, I don't see one that's prime time, that's ready for usage. I assume we're going to see one in the not so distant future, but the point here being is decentralization is a very layered topic and oftentimes misunderstood in terms of confusing it with distribution. So what I mean by that, the primary decentralization is the decentralization of incentive system. It's the distribution is the technology part, and then decentralization is about decentralizing incentives. So that is something that's very hard to do. And so there specifically, if you think about your typical projects that we see on a daily basis, what you should never do is send us a deck where you have a token distribution model. You call it tokenomics, which is a useless term. And that says, oh, we're going to give 20% to the community, we're going to give 10% to developers, and then there's a pool for X, Y, and Z. This is almost impossible to predict. That's like palm reading in this particular case. So the other point to that is we still need a lot of actual cryptographic primitives that make up the network stack. I mentioned that earlier. So network consists of bandwidth, access, compute, addresses. All of those exist right now, but in very nascent stages, right? So right now, everybody probably knows that's listening to this call that Wyoming introduced kind of regulation and optionality for a DAO LLC, which is kind of awkward. You have to have a president, and then also you have to kind of still now more cumbersome than ever have a bank account to then pay the state fee. So you can have a bank account if you're a decentralized autonomous organization per se. You need to have an identified individual. This concept is just very little understood, and I find it helpful to compare it with things like a co-op. So like your credit union is a co-op, to where there's a not-for-profit motive and there's members involved. And that might be, for all intents and purposes, a good transitionary principle to approach. And we see this actually out there in the world where organizations work towards decentralization and intermittently introduce a co-op. There's a company that works like that we've been observing for some time that works towards a decentralized ride-sharing solution. They initially established a co-op for the time being because these other primitives are still missing for the time being.
Right. Well, that's it for the questions right now. Thank you so much, Chris, for sharing your information about the blockchain and investing in it. At this point, I'd like to bring up James Jackson Leake of DeFi Films to talk about a real-world Web3 application. So with that, James, if you could go ahead and turn on your slides and go ahead and tell us more about your application there and what you're doing.
Yeah. Let me bring up the slide real quick. Yeah. Hi, guys. All right. My name is James Jackson Leach. I'm the founder of DeFi Films. I'm excited for the opportunity to show you what my team and I have been building. DeFi Films, my slide's not working. DeFi Films is what we call crowdfunding 3.0, because we have built a B2B and B2B2C crowd staking API. And what a crowd staking API does, for those that are not aware, you have traditional crowdfunding, and then you have what term we've trademarked, which is called crowd staking, which is instead of traditional crowdfunding where you pay for the rewards upfront, flat out, debit card, credit card, bank wiring, you pay for basically non-recoupable contributions into things. And what we believe the future of finance is people utilizing their already staked Ethereum, staked Avalanche, staked Polygon Matic, any number of proof of stake networks where there's a protocol for earning rewards, and they can be involved through our crowd staking API where they're able to re-delegate their APY that they're earning into creative projects, into traditional financial vehicles, into Reg D equity crowdfunding. So traditional crowdfunding is cash for participation into a project or business, and crowd staking is utilizing your staking rewards to be involved in projects, both creative and business. DeFi Films is the Delaware corporation that we're using as our first use case, since film is inherently very risky and is the #1 funded crowdfunding category. That's why it makes sense as our first use case. And here are some numbers on the film category alone for just these two platforms across Kickstarter and Indiegogo. We believe our crowd staking API is going to be instrumental with video games, philanthropy, all sorts of even potentially real estate, but we're starting with film to show the first B2C use case that people are willing to pay $5,000, $10,000, $20,000 to participate in Kickstarter campaigns to be involved in film. We believe people will join a staking protocol and redirect their yield in order to participate as well. So how does our non-custodial staking platform work? Stakers simply come to our dashboard, pick a project that they want to be involved with. They can deposit Ethereum or staked Ethereum, which I'll get to in a little bit. That goes into our protocol. The protocol starts earning their normal APY that they would normally be getting from their regular rewards from, say, staking on an Ethereum network. That goes into what's called a smart collateral wallet, which for anyone that wants to follow up afterwards, I'll dive into all the technical details. And once that smart collateral wallet hits a certain term or a certain balance, depending on the project details, if it's a film or it's a music album, or if it's a Patreon and you just want to give a little bit of your APY in order to keep supporting your favorite comic book artist, it's built for that as well. And then once the contract ends, whether it's film, it's IMDb credits, or it's NFT rewards, or if it's a Reg D crowd staking, there's profit participation, so on and so forth. Basically anything that Reg D crowdfunding is doing or traditional crowdfunding is doing, DeFi Films can do it through our API with staking rewards instead of cash contributions. We have built our API to work directly with Lido. Lido is the largest liquid staking protocol out there. So we've designed it to take Ethereum, but also staked Ethereum, which is a receipt token, so that part of our marketing efforts and the demographic out there is there's $8.8 billion worth of Ethereum currently staked just on Lido. They're in the top 5 of liquid staking protocols. There's hundreds of them, but I designed this to work with Lido directly because they're backed by Andreessen Horowitz and they have a lot of enterprise development behind them. So it seemed like the safest bet. The main reason is there's already $8.8 billion worth of customers there that are familiar with staking, who can simply deposit their STETH receipt token into our protocol, where they're redirecting that said 5.2% APR into our network. So it actually never leaves Lido. It's just a repositioning. But the average person on Lido is staking is staking $32,000 on average. And that's out of the 8.8 billion. This just shows a example of what a staking pool can earn. There's thousands of staking pools out there. This one alone holding 22.6 million. It charges a normal 2.5% staking pool operating fee. So this staking pool operator is earning $567,000 a year just off of its 2.5 pool fee, 2.5% pool fee. And in this one pool of loan, which is one of thousands, there's 13,551 people in this one pool. This slide is important because it shows an example with the Lido slide. Is there a demographic for it? Are people going to be staking their Ethereum? And here's an example of what one small pool is doing. This GOAT provider has 3 pools as well. So that's also how we make money. We do the same thing as Lido. We do the same thing as any other pool operator does. We take a pool tax, a pool fee, ranging from anywhere from 1% to 3% is how we've designed our pro formas. And that ensures us to continue running the protocol. Just DeFi Films alone, not including any B2B2C or future things that we might do. This is if we run our crowd staking API for the film industry and we focus on just that, here's what a high level cash overall revenue is with operating expenses and what after-tax net revenue can look like. But again, to reiterate, we've built this for peer-to-peer lending, music publishing, real estate funds, nonprofits, Reg D, equity crowdfunding, and influencer pools, which I think would be really interesting. You know, if Rihanna wants to hold her own staking pool, and anyone who's in her staking pool gets access to her concerts and future albums and so on and so forth. So the main function of the API is to be sort of white labeled, used across as many industries as people are willing to do normal finance. We believe the future of finance is people just delegating their APY from their staking rewards. Financial summary to date, we've spent about $350,000 building this so far. We have $150,000 cash on hand. That $500,000 came from myself and one other partner, Tony Ross, who's a board member. He invested $100,000, but the $400,000 has been invested from myself. And the platform is about 90 days ready to launch. It is going through, the last ends of testing and so on and so forth. And the point of this raise is to get the extra money for marketing and advertising and launch. Some about our partners. We originally reached out to Consensus to help us build this. They redirected us to Intellect EU, who's the main software developer on our side. But because of the project and Consensus had their interest in it, we are officially in their startup program. So we applied, they accepted us. So we're essentially being incubated by Consensus. We meet with them every week and they help us make sure all of our Infura and MetaMask and all this other things are working perfectly. And they're also just consulting with their higher end senior developers if we want to pick their brain at any time as well. But Intellect EU is the primary developer. I am a mostly non-technical founder, but we do have a CTO on our side as well, who's overseeing their work, making sure that it's meeting all the parameters. The offering details here, raising $2 million, $50,000 minimum investment, 10% equity, 10% interest in the form of equity, and it's at an 8 million valuation cap or 20% discount. I'll send this to everybody afterwards as well. A little bit about the team. My name is James. I'm a film producer. I've been in blockchain since 2014 when I started building my first mining rigs. I immediately started mining Litecoin and Dogecoin and all those things. And I built an entire office room full of these mining rigs where I couldn't even go into my office anymore. It was so hot. I had like 40 GPUs running at 90% capacity. So I've been in the film and tech space for a while. I have a couple technology patents on securing intellectual property. My co-founder, David Buckstein, he is a film producer and also a technologist who works on technology within film. So he recently won an award for his 3D feature film that he won alongside Star Wars and Inside Out. Tony Ross is director of the Americas at Apple. He is a board member and the investor I mentioned. He primarily, his role is mentor, counsel, board member, but he's pretty actively involved. Amber is a financial controller for the company. And then just recently, Alex Stulov has joined as the CTO, but he was not able to send me his lovely headshot on time for this presentation or his bio, but I'll send you this and there's a link to his LinkedIn in here. Alex was actually originally the senior architect on our project with Intellect EU, and he left Intellect EU and he's joined us recently. BlockTech is also an advisory group / incubator that's partnered with us. They've helped from mostly a biz dev perspective, helping with how we're going to approach the music industry or the real estate industry. They also have tremendous intellectual property in the Web3 world. A lot of work out of Japan that's looking to get bridged into the Web3. They have IP rights too. So we have a lot of content, whether it be from manga all the way to anime, if we ever wanted to get into that sector as well. DeFi Films, our crowd staking API is officially patent pending. There's dozens of claims in our patent, but the ones that I am most excited about are the Reg D equity crowdfunding via staking pools claim. Just to reiterate what that means, it means if you join a staking pool and you want to redirect your APY that you're earning, say it's 5% that you're earning on average, our API can allow that to enter into to any Reg D business, whether it's you want to raise $5,000 a year from non-accredited investors, we can cap that contribution at $5,000 a year from the rewards that are being distributed from your APY. The second claim that I'm very excited about is utilizing staking pools to enter the traditional finance vehicles. So if your 5% from your rewards is going to go into, say, your TD Ameritrade account to buy Apple stock, the patent also includes the transferability from the APY rewards to automating it into those financial vehicles. We've also trademarked DeFi Films, crowd staking, and crowd stake. And that concludes DeFi Films presentation.
Thanks, James. Appreciate the presentation there. Let's go ahead and Chris, what questions did you have first?
Sure. So I have the advantage of getting an advanced view of the deck, and maybe I missed this in the presentation now. Can you talk about your traction? I seem to remember you had some data in there where you already ran some campaigns, or am I confused?
No, so it's been mostly self-funded, and we haven't launched yet. I want to make that clear. We're technically in beta. I've self-funded it up to this point because I just don't know if I'm gonna go left or right. And then now that we've honed in on the launch strategy and the go-to-market strategy, now the raise is primarily for marketing and continuing operations for the first 18 months.
Okay, then I'm probably confusing it with a different deck then. Okay, maybe as a side note, like in our space, we typically say flippantly, patents are the best way to prevent adoption.
Patents are the best way to prevent adoption?
Again, because if you're assuming that you're living in a network environment, then you want the greatest adoption of your API, right? If that's what you're offering. So
tell me more about that real quick. So the potential archaic logic I had with filing the patents was there's huge enterprise companies out there that have tons of cash, and someone is going to have a crowd staking feature at some point, most likely. Yeah. So it made sense to protect that IP, but just to make sure I'm hearing you correctly, you're saying that it would behoove me to let as many other companies as possible have a crowd staking API.
Yeah, exactly. Do exactly the opposite, because you're not buying yourself any protection at the end of the day. I mean, you probably know that that's not how patent wars work. If someone wants to invalidate you that has a bigger portfolio, they're going to invalidate yours by just presenting them. But again, this is more a tangent. That's a little nerdy. But I usually discourage people in our space to make that a point, spend any effort on there, spend effort on adoption and getting it out there. So your business model is to take part of the transaction, right?
Yeah, our revenue model is just like Lido and any other staking pool. We take a percentage of the rewards that come out from delegating.
Right. And so how are you thinking about any regulatory exposure that you're creating because you're part of that transaction? How do you wiggle your way around that?
So the securities law firm that we're working with, I brought up what some of the other companies were doing that were recently getting pinged by the SEC, and we're pretty much doing exactly what, say, Coinbase is doing. They're actually taking your Ethereum, locking it up in the network, and then redistributing those rewards back to the holder of said Ethereum. So that's exactly what we're doing. And from a regulatory standpoint, we're not like Kraken got pinged because they were actually letting you stake anything and then paying you back out in various types of tokens and assets, which is definitely.
They did a little more than that. They optimized it. Yeah, but still, I would also discourage you from being part of the transaction in any shape or form.
Tell me more. So
you're just increasing the risk. I mean, again, we're still going to be some time away from any type of regulatory clarity in this country if this is where you want to operate. So that just makes it, from an investor's perspective, very uncomfortable, right? So to not have that, and Gary Gensler stepping on TV every other day and talking about states specifically and putting on Google videos.
I'm curious to hear more about the regulatory issue. Is your thought that do you believe that, say, a company like Lido will also be breaking a regulatory issue?
My personal beliefs are like completely the opposite of Gary Gensler's, as in I think he is 110% wrong on everything that he's saying, because what he is trying to do is essentially mind reading. So what I'm saying here, if this technology is implemented in its primary function, which is to facilitate peer-to-peer transactions, again, that's why I was harping on you not being a middleman to the transaction, not being part of that transaction, then you shouldn't have any regulatory exposure. If you just take a step back and you look at any blockchain entry, what do you see? So you see a control address and a receiving address, you see an amount, you see a fee, and maybe some other data points. But from this data points, it's almost impossible and very, very, very unlikely that you can determine the legal nature of that transaction, right? It's, again, it's mind reading. It's all completely situational. As a former lawyer, I look at this with a very simple framework. There's only 4 legal ways that that value changes hands, if you will. So you're paying for something, you're getting something back. You're sending money in another direction and you don't want it back, which we call a donation. Or you're sending money some way or some other asset some way, you want it back, we call that a loan. And then we have this edge case of we have a common enterprise thing. Right? But these are really only from a legal perspective, the only 4 ways. So to be on the clear here, for me, it's very simple. As kind of a person who thinks like a legal engineer, you can cover all of that in your client software, or you can cover all of that in your standardized smart contract that we usually call a token. So again, that's, you asked me about my personal perspective.
Mm-hmm.
My personal perspective, it's absolutely clear as mud. There's no confusion here. I think regulators just cause confusion, and it's motivated reasoning. But yet again, unfortunately, you'll have to deal with that in terms of other investors who don't have that clarity in their head, and then more importantly, to still deal and spend unnecessary legal fees. And my advice is always the same. It's kind of binary. So either you raise an enormous amount of money to be prepared for that scenario, you integrate with the legacy legal system, with the legacy financial systems, which will cost you an arm and a leg. You should be raising $100 million, or you build it up from first principles. And so when you build up from first principles, you build it in a way that you never have any insights into the legal nature, into the value that's being exchanged, which you usually, and totally interested to hear a different opinion on that, will usually put you in a position where you're never part of the transaction at all, where there's no correlation. Right? It could be simply something like, okay, this is a membership system. Everybody who wants to participate is being charged a monthly membership fee, right? And I don't know what you guys are doing while you're in my club. That's
interesting. Yeah, that's great insight, because we designed it so it's 100% non-custodial and everything lives in the smart contracts. And then we just mathematically, every time a new block is issued, some of it goes into our operating wallet. But what I'm hearing you say is we could bypass even that and just say, to participate in this, you just have to pay, $50 a month, like
exactly. And I mean, as you know, with the whole FinCEN and OSHA decision, they don't care if that's a decentralized smart contract that no one can influence, right? So they will just put something on the OFAC list and then you're done. For no particular reason. I mean, again, there's a lot of education needed, but more importantly, I think we need to stop the funding sources of this type of misinformation and action.
Mm-hmm. Well, it's interesting. Most of the non-custodial aspects of it are for the consumer to be safe and feel safe.
Right.
And then actually what you're saying is it's actually technically easier to build your revenue model than what we're already doing. So
indeed.
Yeah. Cool.
And maybe let me hand it over to Carl, who's listening, and if he is in a position to ask questions, because in our Skunkworks division, we built something already that's not too dissimilar to what you do.
Carl, any feedback there?
So then how are you planning on scaling the product?
The B2B to C thing, that revenue model of it would be having a sales team or myself go out and actually get, other industries, influencers. Like the ultimate goal, like the dream client would be like a company like a Reg D crowdfunding platform that actually says, okay, so we can actually put this on our platform and people can join a staking pool. And then those rewards go into, say, buying equity in that coffee shop in their neighborhood kind of thing, for operating capital. Or, Patreon, that would be like a gold standard of like, oh, instead of giving $25 a month, you're literally just joining that creator's staking pool and you're putting $300 worth of Ethereum in that creator's staking pool, giving them your APY and giving them your rewards. So from a B2B2C standpoint, it's all sales and talking to other industries and other companies that may want to integrate a platform like this. For the first use case of film, it's launching a crowdfunding campaign just like you would on raising money for a film on, say, Kickstarter. It's driving traffic to it, targeting mainly the Lido people since we've built it to take the staked Ethereum. And then the intersection between gamers and filmmakers and crypto is fairly strong. So we would, for the first use case of B2C for DeFi films, that's what we would do, is launch that campaign.
Okay, and do you have any beta users on the platform right now?
No, right now there's no users on it. It's like when we launch it, it's not going to be, it'll be tested and ready to go, but we can't, when we do a fund to launch for film, it's kind of you got to launch it and raise the principal, because we're going to treat it like a traditional crowdfunding campaign, give people 30 to 60 days to sign up and join this pool. The user behavior of traditional crowdfunding is that 30-day campaign window works really well on getting people as a call to action to join, become an executive producer on a multi-million-dollar movie. And, that'll be sort of that marketing play on that. For the B2B2C thing, we're building that anyway. We're going to keep finishing that. It's pretty much also going to be done around the same time. And that's where I'm talking to like video game studios. The good thing about the video game industry is that's like mostly payroll. So reoccurring monthly revenue from a staking pool is good because it's engineers and artists that just need to keep working and building. So we're talking to a couple groups that are mostly video game developers to launch something similar for them.
Okay, and then in terms, this is a Web3 product. If you're going to scale this beyond, let's say, people that are familiar in the crypto community, what do you think is the biggest obstacle from a user experience for adoption?
Oh, the biggest obstacle is people who have no idea what staking is and how to join a staking pool. Anyone if you don't have a Web3 wallet, then you're not going to be able to participate. So that's why guys like y'all who actually have a Web3 wallet and companies like Coinbase that have Coinbase wallet are paving the way of educating, when I can come in behind them and be partnered with companies like Lido and Consensus and so on and so forth. So as people start getting more familiar with Web3 wallets, we're an application for them to play within.
Okay, and right now you support mostly any Ethereum Web3 wallet, right? Using Web3 Connect?
Yep, Web3 Connect and MetaMask Coinbase wallet. It's all those. And we've built this on Ethereum, of course. So with EVM, we're looking at Polygon. We're definitely keeping a close watch on as soon as Lido starts allowing for AVAX, but the bridging between the P chain and C chain is something that I couldn't solve for a non-custodial staking protocol. The Lynx, I think it's Lynx that's trying to do it. But yeah, so anytime our total market cap of available users is going to grow with Ethereum, with Avalanche, with Polygon, and then eventually we'll build it for Cardano and all those different protocols.
Okay, so right now that you have this on Ethereum, do you think the fees are an issue?
The fees for transacting are not an issue because of the way that we've designed it to be in batches. And then right now, one of the things that we've recently kind of honed in on is at what point do we let the user pay for it, and at what point do we pay transaction fees? But so far, the GUI on it is not a barrier for us or the user.
All right, great. Yeah, that sums up any questions I have. Pass the mic back.
Great, Carl. Thank you for that. And thank you, Chris, as well for your questions. Got more comments in the chat box. We'll share that with everybody who hasn't read it already. It appears there's a lot of agreement about Creative Commons are the essence of the decentralized world that's emerging. Thank you, James, for your presentation as well. We'll connect everybody afterwards for follow-up calls. I want to thank everybody for joining us today. We're at the end of our time. Thank you for staying with us throughout this time. It was a great presentation from both Chris and James. And with that, we'll go ahead and close it, and we'll see you guys next time. Have a good one.
Thanks all.